Buenas tardes, bienvenidos una vez más a Casting Strategies. Hoy tenemos una de esas entrevistas en la que nos pasaríamos hablando no toda la tarde, sino todo el día con la persona que vamos a entrevistar. Es el autor de este libro, Dear Chairman. Su nombre es Jeff Gramm y es una de las, quizá de las personas que más sabe sobre activismo y una de las personas más interesantes actualmente en el panorama de la inversión en Estados Unidos. Jeff es gestor de su propio Hedge Fund Bandera Partners y es también, curiosamente, profesor adjunto de la Columbia Business School, el lugar en el que nació el Value Investing. Hi, Jeff. Thanks to be here with us this afternoon. We are totally glad to have him with us today. We are ready to learn from you about all these things that you have to teach to us. And the first question that I wanna ask you is, how did you get to this world of investments? How do you start? How did you find this world? And how you became professor and also investor and all the stuff that you are today?
Mm-hmm. So basically, I went to business school. It's like like when I came out of undergraduate college, I played music for a few years, and I went to Columbia Business School in 2001. And I really didn't know what I wanted to do, but an MBA degree in the US, it's a very versatile degree. Like you can come in like from any kind of a background, and then when you get a business degree, it opens up a lot of different opportunities. You know, had I gone to law school, it would have been a lot more restrictive. I probably would have ended up a lawyer, but I went to business school, and at Columbia, I took a class in investments. I didn't know anything about investments. I didn't know anything about accounting. But I took this class with Joel Greenblatt, who was at the time, he had written a book called You Can Be a Stock Market Genius, which is probably my favorite book about investing. You know, I didn't know who he was. There were 3 sections of this class, security analysis that was offered, and I happened to get Joel Greenblatt's because it fit my schedule, and it was really life-changing. You know, the whole idea of buying a 50-cent dollar and like doing this extra, you know, research and trying to figure out things that the rest of the market didn't know is just like really captivating for me. And I felt like it really clicked. So I went out and I took a unpaid internship at a hedge fund. And, you know, you had to remember that in the early 2000s, the hedge fund industry was really growing. It was like almost like a bonanza, you know, like a bonanza growth. So there were new funds popping up everywhere. I got a job as an unpaid intern at a distressed investing fund where you invest in like in companies that are having financial distress, so bankruptcies, bonds that have defaulted, things like that, which is actually pretty related. It's very valuation focused and has a lot in common with activist investing. So my first 2 jobs, you know, were ultimately in distressed investing, and that place where I was an unpaid internship, like they offered me a job when I got my, you know, when I graduated from business school, and that's pretty much what set me on the path. So I was very, very lucky. I feel like were I to come into this industry now, you know, so had I been 10 years younger, I feel like coming from a music background, going into business school, it would have been much harder for me to get a job at a hedge fund. Yeah. But I was very lucky to kind of have come into that industry at this time when pretty much anyone could get a job in it.
Well, Jeff, it's really motivating because especially Lorenzo and I are totally fans of Joel Greenblatt also. We have read everything he has, and talking to you, it's just a pleasure. You actually now are currently professor at the Columbia Business School, so you are teaching now Benjamin Graham and Buffett's style value investing, if I'm not wrong. It's correct, this?
Yeah.
Okay.
Yeah, so... Oh, sorry. Yeah, so Columbia, they do a really nice job of hiring adjunct professors. And what that means is like they hire people who actually work in business, people like me, to come back and teach classes. So I first did that in 2010. I taught for 7 years. I took a few years off to promote the book. And so I actually haven't taught since I think fall of 2017. But I think I'm going to go back soon, either teaching, value investing, or I would love to do a class on activism. But part of the thing that was so captivating about the Joel Greenblatt class is that it wasn't like academic and professors and lots of kind of fancy concepts that weren't very practical. Joel Greenblatt was very down to earth, explained how things actually worked in investing, like without using like a lot of fancy math and formulas. And I think that's why Columbia has, they bring back a lot of people like me to come and to try to do the same thing. So in my class at Columbia, it's called Applied Value Investing. It's a very simple class. We basically look at a new company every week, and we'll do valuation work on it. Like we'll discuss as a class what we think the company is worth, and what I'll try to do is bring in a special guest for the second half of the class who really knows it. So it could be a hedge fund manager who is a big shareholder in the company, or it could be the CFO. It could be like a store manager if it's a retail company. And it's a very powerful tool, I think, in education when you do all your research as a student and you form a lot of opinions, you decide what you think about a stock, you all talk about it, but then I bring in an expert who really knows, and it turns out that everything you thought you knew as the student was kind of wrong.
Well, yeah.
that's like the moment that I gun for, that kind of aha moment of like, oh, I thought this was how it was. Actually, it's like this. Like, I think that's a really powerful way to learn. And so I really tried to design the class like around that moment.
Well, that's
like, now I understand how that works.
So Jeff, I'm here listening to you and your stories about the Columbia Business School, and I want to close everything, take a plane, and go there and start learning again, because these stories are amazing, Yeah. And you are talking about learning with Joel Greenblatt, that is one of our, best investors. Never, you can't find someone like him, so easy. And, I want to close everything and go there. This is what I want to do. So let's go to the reality and let's close this door, please. I have here your book. I have enjoyed reading this book a lot. And one thing that people doesn't know in Spain a lot is all the stories about Graham and Buffett in the activist way, that they were really activist investors, not only stock buyers or stock pickers, but really activists. Can you talk something about Benjamin Graham and the Northern Pipeline story to show us how these guys were, how this guy was the first activist, and how this clever guy, started with all of this path that a lot of people, as you and a lot of people, have followed after?
Sure. Yeah, so, Benjamin Graham, if you don't know as a listener, he was a very famous investor who was a mentor to Warren Buffett. And he's often called the father of value investing. And as you might know, what value investing is buying a public company, ultimately at a price that the market gives you that is less than, the true intrinsic value of that company. And you have to remember that when Benjamin Graham was doing this in the 1920s and the 19-teens, and even when Warren Buffett was doing this in the 1950s and the 1960s, that public companies were often very poorly governed. They were often run for the benefit of the board and the managers, not necessarily for the benefit of the shareholders. And so when someone like Benjamin Graham found a company that he thought was very cheap, and to him that often meant, cheaper than the liquidation value of that company. And not just that, cheaper than the liquid assets of that company, like the cash in the bank account, things like that, like the receivables. Often, like those companies were that cheap because the management and the board were not acting in the best interest of shareholders. And so what he often had to do was agitate for them to do the right thing. And at the Northern Pipeline Company, which was a pretty fascinating case, he found a company where, they had something like $90 per share of liquid investments. So basically cash, they were very, good bonds. And the stock traded at $60 a share. And they didn't need to have all that cash in the business. And so Graham thought, well, geez, they should just return that cash to shareholders, continue operating the business, but the shareholders should get, their $90 in bonds right now. And so he went to go talk to the board, and the board was basically like, no, we don't want to do that. And so he ran a proxy fight to add his own representatives onto the board. And he ultimately persuaded indirectly the Rockefeller Foundation, which controlled this company, to do the right thing and return that cash to shareholders. And my book is organized. Here. My book. Here's right here. It's organized with each of these cases. And so in each chapter, I'll take, Benjamin Graham, and I'll go through a specific investment of his, or I'll take, Warren Buffett. And then in the appendix of the book, at the very end, I've got the original letters that Ben Graham or Buffett wrote to the companies. And so in the Benjamin Graham chapter, I have the letter that he wrote to the Rockefeller Foundation explaining, hey, you need to do the right thing here and pay out this cash. In the Warren Buffett chapter, I have the letter that he wrote to American Express in 1964. This copy of the book was actually signed by Warren Buffett.
Yeah.
Which is pretty cool.
That was my next question, but you have discovered exactly.
You wrote something for me.
That's a story that you have to tell us also.
And too. He just wrote this funny. I knew that he liked the book, and he just wrote this thing to Jeff. It's only a matter of time until you are the recipient of a Dear Chairman letter, which is a pretty funny inscription, because in some ways it could be interpreted as a little bit of a dig. If you get a Dear Chairman letter, it means that you're in dispute with your shareholders.
Exactly.
And then at the end of the book, in books you write these acknowledgments, like they call them, where you kind of thank all your friends and all the people who helped you. And I thanked him because he really, when he gave me the letter to include, that kind of gave me the motivation to actually write the book. And so I wrote about that, and I wrote about that he Buffett probably spent 30 seconds finding that letter and giving it to me, and I spent a year at a keyboard just because of that 30 seconds, so he wrote about that.
Yeah. Incredible.
Quite incredible
Awesome.
story.
I keep
Awesome
that
story.
here.
So in this case, keeping with the same idea, what retail investors can do if they are not satisfied with the management. So this would be a practical case. Currently, if we are shareholders of a company, so what we can do?
Yeah. No, I mean, it's a great question. And, it's kind of, there's a lot of different ways to answer it. Like, I think the first way is like just breaking down the rules. It's like in the US, the shareholders vote on the board of directors. Like most other countries, it's the same thing, though there are some intricacies, like with each country and in the rules, around that. But generally, the U.S. has rules that are pretty favorable to the companies and make things hard for the shareholders, whereas, countries like England actually have more pro-shareholder rules. But basically, like you as shareholders can nominate, directors to be on the board and try to get them elected. Now, practically speaking, that's a hard thing to do because you need to get the support of all the shareholders. And a lot of these shareholders are going to be big institutions that are going to be very wary of, putting new, inexperienced directors on a board. And so what you really need to do is, try to understand, like, where is the discontent among the shareholder base? Like, am I the only person that's unhappy, or are there lots of people that are unhappy? If a lot of the shareholders are unhappy, like that gives you a way like to force change, because if there's enough, a discontent in the shareholder base, then the potential for new directors to be elected on a board is greater, and that gives you more leverage, Yeah. But practically speaking, if you really want to go through the full fight, if you really are an angry shareholder, and you want to nominate some people to the board of directors, it's a lot of work, and you need to have a good lawyer, and it's like a very specific, complicated process that you want to master. Like, you don't want to go in your first time without the best advice. And one thing that happens to lots of value fund managers is you'll eventually in your career have an investment in a company that's undervalued where you think the board and the management are not doing a good job, and you want to make changes. And lots of the most problematic, unsuccessful activism comes from first-time activists, because there's a lot of rookie mistakes that you can make. We call that, when you make a mistake the first time that you do something. In the U.S., it's called a rookie mistake. Uh-huh. So it's a very kind of, a specialized process, to do this intervention, and it's a legal process. And so you need a good lawyer. That's the main thing.
Okay, thank you.
Do you think, Jeff, that activism was easier at the beginning when these guys were working because they were the first activists, So maybe the companies and the lawyers of the companies, they were not prepared, maybe, as they are today for this kind of things to happen? And do you think that today is more complicated, and then it's a narrow space for people, for companies, for investors to be an activist and to take advantage of this situation? Or do you think that maybe it's possible, it depends on the company or the situation? What do you think is the situation today for the activists, and if it's possible for someone to go through this direction to make money in the markets those days?
Yeah, I mean, it's a good question, and in some ways the answer is yes and no. In some ways it's easier now, than before, and in some ways it's harder. So when you think about Benjamin Graham doing this, you're absolutely right that the Northern Pipeline Company didn't take him seriously. They really they didn't think that he was actually going to go through with a proxy fight. There weren't like specific legal defenses like the way that there are now. And so they very much underestimated him. At the same time, the hurdle for getting people to vote like against the board has historically been very high. Especially in the 60s and the 70s and the 80s, lots of big investors were very biased to just support the company. And the way that a lot of these investors operated was either support the company or sell your shares, but they're not going to, vote in support of an activist. And I think that now, even the biggest, most conservative institutions, be it Vanguard or BlackRock, pension funds, insurance companies, they will support an activist if they think that they're right, if they think there's a good case for change, and if they think that the existing board is not going to make those changes. And so, in some ways, now is a great time to be an activist because everyone is conditioned, like to kind of evaluate you objectively. But that said, it's a difficult process, and it costs a lot of money. It takes a tremendous amount of time, and investors still will give the benefit of the doubt to, the incumbent board. So if you, get upset with a company and like you want to run a proxy fight and like you want to propose a whole bunch of changes, like the board, they know they can talk to all their shareholders, like figure out which of the changes to agree to, like enough to win their votes to keep you out of the board. But that doesn't necessarily mean that activism, even if you lose your fight, like you might be, driving value and improving things at the company. So I still think that even like activism where you do not win and get board seats, you can make positive changes. And so I think that now is an easier time to be an activist than in Benjamin Graham's time.
So in this case, if you, because being an activist has been, over the last maybe 30 years, 40 years, has been a great style of investment. A lot of people have made a lot of money. So does it pay off this idea of being an activist and try to face these kind of complications along the way to make money?
Yeah, I think it's hard. Like, I think if your investment strategy is just purely activism, I think that's a hard business model and it takes a lot of resources. And I think that's why, when you look at the major activism in the US today, there's more activism than there was, we'll say 10 years ago, but it's kind of, more concentrated. There are, in some ways, fewer activists. Yeah. And you have these, shops like, Elliott Associates, who are a huge percentage of activism now, and they have, built out a whole team and a whole process. And, so I think it's hard to have a fund where activism is your key strategy. Like, I think that ultimately you need to be a value investor. You need to pick good stocks. Like, you need to be right on valuation. It's great to have activism as a tool. Yeah. It's great, if you have been there, have done a proxy fight, have gone the distance, it gives you, I'm not sure if credibility is the right word, but it gives you a little bit of a different, form of leverage with companies, when you're upset with them. So to me, it's a tool. It can be a useful tool, but as an entire investment strategy, I think it's very difficult. And, I think a very good example of activism as an investment strategy as a shortcoming in the US is this investor, Bill Ackman, I mean, I think he's a very good investor. He's a very smart guy, and he had some huge successes with activism. And then he decided at some point, I should really focus all of my positions on things where we're engaged and we're active.
Yeah.
And so like at some point he decided, every investment is going to be an activist position. Mm-hmm. And it didn't work for him. Mm-hmm. And I think he's back to realizing, oh yeah, if you can buy a cheap stock, and he's, good at finding cheap stocks. If you don't have to engage, if you don't have to be the person in the boardroom, like restricting your liquidity, taking up your time, using up the resources of your team, it's a way better outcome if you can get the same return without the activism.
Yeah, so it makes all the sense.
So it's interesting what you are saying, because then you say, okay, activist is not for your whole portfolio. It's maybe something that you can do once or twice when you find an opportunity, but you have to be a value investor, no? And how do you find value investing today? Because today we have a great debate about value investing. Value investing is not working. A lot of time value investing is not working in the market. You have a lot of value investors doing worse than the market for a long time because of the growing companies, because of the changes of the market, because of the passive investing, because of a lot of things. So how do you see the situation of value investing? How do you see the approach of value investing, and how do you think that this is going to work in the future as it has worked before? Or how will be your position in all of this about value investing?
Yeah, I mean, I think that's a very good question. And I mean, honestly, I'm very optimistic about, value investing, like traditional fundamental investing as an investment strategy. Whether we will continue to be able to raise assets for value investors and as a business model, that's a different question. But I feel like the last 2 or 3 years, have been really good. I've found more ideas I'm excited about in the last 2 or 3 years than in the years before that. I feel like I'm seeing more situations where stuff kind of happens and fewer people notice. I've had 2 or 3 situations where, we were involved in a deal this year where there was, I'll give you 2 examples. In the first one, it was, one of these classic situations where it was a public company and there was wide reporting on them going through a deal process to sell their company. And it just felt like it didn't quite trade to where it should have, given that reporting and the kind of the legitimacy of the reports that they were going to sell the company. And it felt like, 3 or 4 years ago, that wouldn't have happened. The equilibrium of that, trading price would have been higher. And then we had another situation where we were investors in a company that was doing an aggressive, share repurchase, had a small investment float that had a high short interest, and their proxy statement came out, and on the last page of the proxy, it shows the share count, and the share count was drastically different from as reported in the 10Q previously, to the point where the short interest just rocketed up. And I felt like no one noticed for weeks. And I just feel like we're in this environment where, hard work is being rewarded. Now, I'm not going to ever say that that value investing is the best investment strategy. I feel like it's the best investment, strategy for me. It's the style of investing that I can do and that fits with my disposition. I'm very much a believer that, quant investing can be great. High frequency trading can be great. That the returns on those kinds of investing are probably way higher than than on my kind. I mean, if you look at at high frequency trading, I mean, I think the returns like for that were like effectively infinite because, like you had these investors, or like if you want to call them traders, who for, probably over a decade, just had a black box that printed money and that deployed very little capital. So I would never say, oh, well, value investing is the best and it's like the only way to do this. But I'm a long way from thinking that it's not a viable way to beat the market. I, will still very much believe that concentrated investing in companies that very well, or that you have a sense, or that you understand the market is completely, misunderstanding. That's still a very good way to make money.
Yeah, it's kind of in our case, I think we feel pretty all the same because value, it makes sense per se. The idea makes all the sense. So then it's easier to stick in the strategy. Very likely, it helps. This idea helps us a lot. And I got a last question, Jeff. That is, given said all of this, if you have to create a portfolio, what would be the portfolio in your case? I mean, what would be the concentration of the portfolio? It's a big portfolio, concentrated portfolio. So how would you manage the portfolios where you are trying to find good opportunities, terrific opportunities? So you concentrate it, or you try to have a good diversification?
Yeah. So, I mean, I probably find 2 to 4 ideas a year that I really like. Sometimes more, sometimes less. So for me, 10 to 15 positions is about the sweet spot. I'm very kind of aware of the dangers of concentration, of the dangers of holding a position for a long time and being concentrated in it. That can really cloud your judgment. And when people who do what I do blow up, it's usually overconfidence in a position that they have then over concentrated in. And it's a very human thing to do when you have an idea that you really like, that you have then owned for 5 years, and then you just will really think the market is getting it wrong and the stock is cheap. Like that stock being cheap really taunts you. You really want to buy more of it. And so I am very wary of the risk of being too concentrated into things, because ultimately we're all more fallible than we think we are.
Yeah.
But at the same time, given the kind of lack of productivity in my, idea generation, given I might only find 2 ideas in a year, 10 to 15, positions in the portfolio is about my sweet spot.
Okay, Jeff, it has been a pleasure to talk with you. I'm really, excited about this talking, because you have a great background, you have a great teacher, and you're a great guy. So thank you very much for all the things that you have said. And I have to say you one nice story, because you have shown your book with Warren Buffett sign, and I can show to the people that is watching us your book with your sign to me, that you did it.
Yes.
In Omaha, when you were signing books there in Omaha last year. Awesome. Where I bought your book, so I can show your letter here as well to the people. You are not Warren Buffett, but for me it's all the same.
Well, thank you for taking the time to read the book.
Okay, thank you very much. Thank you very much for this talking. And we will ask you for sure to be again in our show. I'm sure about that. Thank you very much.
Great. Thanks a lot.
Thanks.